We'll now take you to Côte d'Ivoire, Abidjan, for a playback of today's session of the 2025 AfDB annual meetings. Please stay with us.
I'd like to, on behalf of President Akinwumi Adesina, welcome you to this thematic knowledge event. For those with us in the room and those joining us virtually all across the world. This thematic knowledge event is looking at the findings of the second chapter of the African Economic Outlook report for the year 2025 on making Africa's capital work better for Africa's development. And we launched the report 2 days ago here in this room. So I'd encourage you to get copies of the report, which will be provided in this room for you to look at the details of what we are going to be discussing today. This particular knowledge event will focus on leveraging Africa's capital for development amidst increased development and economic challenges. We know we are living in a world where uncertainty is almost now the rule of the game. We are seeing a lot of multipolarization in global economic governance. We are seeing challenges in trade and trade policies. We are seeing challenges with debt and access to capital. We are seeing challenges with increasing costs of capital for Africa. But Africa has huge resources in all forms of capital, be it human capital, natural capital, fiscal capital, business capital, but also finance. Africa has huge opportunities to leverage these in order to be able to drive development on the continent. So this particular thematic event will allow us to dig deeper on what Africa can do in order to be able to leverage its own capital in the midst of the changing global environment that we are all witnessing. And to help moderate that event will be no other than the innovative, smart, intelligent, one of the best finance vice presidents that I've seen in the world, leading innovations for all the MDBs on how to actually leverage capital. So why not call you to the stage, Vice President Hassatu Nsele, the Vice President for Finance and the CFO for the African Development Bank Group. Thank you.
Thank you very much. Please do not believe him. Good morning to all of you. It's a pleasure to see you, and apologies that we are starting a bit late. And again, welcome to this knowledge event. Looking forward to this conversation with a very distinguished and expert panel. So I'm very delighted to have with me today the panelists that are going to share their experience in light of the huge financing gaps that the African continent is experiencing. And this requires a solution to promote the economic and social progress of the African continent, while also identifying key challenges and opportunities. So let me welcome Dr. Denis Denia. If you can please come to the stage. Mrs. Abena Amoa. Dr. Razia Khan, she's online. And Mr. Chika Mordi. Pardon. Monsieur Diouf, pardon. Monsieur Ibrahima Diouf. Good morning to you. Good morning. Do you hear me? Ça marche pas? Le micro ne marche pas? Can you have the mic on, please? Hello? Okay. Hello? Okay, thank you very much. So maybe I'll ask, our panelists to introduce quickly themselves. Maybe I'll ask with Mr. Diouf here.
My name is Ibrahim Diouf. I'm the special advisor to the president of BOA, the West African Development Bank.
Good morning. My name is Dennis Denya. I'm the Senior Executive Vice President for the African Export-Import Bank Group.
Good morning, everyone. My name is Abna Moa. I'm the CEO of the Ghana Stock Exchange.
Good morning, all. My name is Chika Modi. I'm chairperson, I should say, of United Capital.
Thank you. Thank you very much. And maybe let me start. Dr. Razia Khan, please. If you can introduce yourself. We cannot
Least at Standard Chartered. A pleasure to be with you this morning.
Razia, we didn't get the first part. Could you please go on again?
Razia Khan, Head of Research, Africa and the Middle East at Standard Chartered.
Thank you, and thank you very much all for being here with you. So maybe let me start with Dr. Denis Dinia. So in light of rising global trade tensions, declining aid, and heightened volatility in capital markets, how is the Afrexim Bank adapting its trade finance and countercyclical lending instruments to help African countries mitigate external shocks and preserve access to affordable capital?
No, thank you for that question. But let me begin by giving you the context of Afrexim Bank's own creation. If you recall, Afrexim Bank was conceived in the late 1980s in response to the South American debt crisis. So when the African Development Bank and Ministers of Finance saw the declining availability of trade finance on the continent, they formed Afrexim Bank and we started operations in 1993. So our own creation was a response to crisis. And so responsiveness to crisis is in our DNA. So if you look at the last 10 years, we have faced three major crises. Firstly, 2015 to 2017, the commodity price shock. Afrexim Bank responded to this crisis by providing a 10 billion counter-cyclical trade liquidity facility, which enabled member countries to respond to the reduction in foreign currency inflows, mitigating the potential to not honor their trade obligations. We then had the COVID-19 pandemic. Afrexim Bank responded significantly, not only in terms of procuring the vaccines, but in terms of engaging the continent so as to procure the medicines, the protective equipment. We provided 2 billion guarantee to enable Johnson & Johnson to give priority to African countries in terms of vaccines. So we have been responsive. When the Russian-Ukraine crisis happened, we provided a response, which is the Ukraine mitigating facility. $10 billion was put on the table. We have continued to expand the bank itself by providing additional activities. For example, we have launched the Fund for Export Development to complement the debt that the bank provides. The Fund for Export Development provides equity which will enable African countries and African entrepreneurs to establish export-oriented entities and will generate more foreign currency. In terms of actual products, we launched a central bank deposit program to raise money so that African resources work for the development of Africa. From $14 million in 2014, we have raised over $34 billion from African resources, from African central banks, to deploy for African development and respond well to crisis. In 2023, our shareholders agreed to institute a concessional window. They themselves provided $200 million as seed capital. So this concessional window will help in crisis response and also in terms of financing SMEs. So we have diversified the sources of our funding. away from the Euro markets. Last year, we raised money in the Japanese market, in the Japanese capital markets. This year, we raised money in the Chinese capital markets. So that helps in us not depending on one source of liquidity, therefore in enhancing our response preparedness.
Thank you very much. Ms. Abina Amwa, the current global context marked by growing threats to multilateralism underscores the importance of developing robust local financial markets. So based on your experience, what decisive steps can African countries take to build dynamic, deep, and liquid financial markets that support the mobilization of financing for economic transformation?
Thank you very much. And let me give a warning. I'm here to speak on behalf of all of Africa's capital markets and securities exchanges, especially as I'm surrounded by bankers on this platform. As we all know, or we hear the rhetoric that capital markets are central to economic development, channeling domestic savings, partnering with international capital towards investments in the private sector, in the infrastructure, and other sectors that will fuel capital markets or wealth creation is very, very important. But listening to many of the things that have happened, you'll see that Africa's development has been a lot driven by the government institutions, and capital markets haven't been at the center of our economic development. And that's what all of us at the African Securities Exchanges Association are looking to change. When my colleague talked, he talked about raising capital in Asian markets, etc. What are we doing about creating opportunities for Africa's retail investors, our corporate investors, to participate in the development of Africa's economies? And so I would like to, sometimes we say there's no money in Africa. Is that really true? We have pension funds that just in West Africa, between Ghana and Nigeria, almost 40 billion US dollars of pension funds that every day say they don't have investment opportunities and are parking over 90% of their assets under management in government securities, which largely go and pay salaries and do very little investments in the real sector. What are we doing in the pension funds industry? We say the retail investors don't have money. Some statistics I just looked at. In 2024, Africans invested 125 billion US dollars in cryptocurrency assets. 125 billion US dollars, mostly by individuals. Nigeria is the second largest cryptocurrency investor base in Africa. Over 65 billion went from Nigeria, only second to India. Where did all that money go? Outside of the continent. And we talk about capital gaps. And our development finance institutions are issuing bonds outside of Africa. So it's time for us, and the topic is very important, it's time for us to see how we co-invest with African institutions, create products, educate the retail investors, and channel all of these onto our securities exchanges. There are over 30 securities exchanges with limited products, mostly led by South Africa, and there's the need to develop more of these. How should we go about it? I think first and foremost, we must champion national as well as regional savings and investment plans or strategies. The EU has just launched theirs in March this year, the Strategy Savings and Investments Union, of the European Union, where they are looking at how we get retail investors to co-invest with the pensions and institutional investors in selected key sectors, even including defense, SMEs, etc. And so for me, the message today is that contrary to the way we've approached our economic development, it's time for all of us to focus domestically. Because when the money runs away, when USAID runs away, when European funding runs away, we must look at who can we use to create the wealth that Africa needs. And I dare say that our SMEs, our infrastructure gaps, there is money in Africa today. And with smart policies, which I'd like to talk about in my second further on, we can come up with a structure that helps Africans benefit from the wealth creation that we provide other economies. Thank you.
Thank you. Thank you. Thank you very much. And I'm sure you know that the African Development Bank has been involved in conducting security exchanges on the in the continent, and it's a work that is ongoing. So let me now turn to Dr. Razia Khan. So despite the growing number of private banks in Africa, access to finance remains a major challenge in general, and in particular for women and young entrepreneurs. So what needs to be done in order to unlock long-term and affordable private financing for women and youth-led enterprises?
Thank you, Vice President. There are two main parts to this. I think many of the panelists have touched on the current global economic situation, the volatility that we currently see in US Treasury markets means that Africa as a whole is likely to see a period of considerable uncertainty when it comes to broad capital flows. The funding costs for a lot of the institutions from the outside that would normally be thinking of African opportunities have certainly risen. But there is a whole other part to that, as my fellow panelists have touched on, and that is the capital mobilized within Africa itself. Why is it that we see these restrictions to access to financing for key constituents who could really do with the boost to boost their overall economic opportunities? Now, decade after decade, we've had various discussions on this. The depth of financial intermediation in Africa, the cost of providing these services, the regulatory environment. Are things changing? There's been reference to the adoption of digital currencies, and one would think that in this environment that broadly fosters the take-up of greater, newer technologies, we should be seeing a sweeping change in access to finance for the previously excluded. But the fact is that this doesn't seem to be happening, it isn't underway, and this certainly needs closer examination. The traditional arguments given were a range of macroeconomic instability, very high interest rates, a significant amount of risk aversion on the part of lenders. They were only ever going to be lending to those customers that were seen as the safest bets, and there was really very little risk taking, let alone maturity transformation. So not only were Africa's corporates somewhat disadvantaged by this, the absence of any longer term financing, but certain demographic groups may have found themselves significantly cut off from any meaningful access to financing. What needs to change? The more we see regulatory attention devoted to this, so central banks, apart from doing their roles as helping to bring about price stability and over time lower interest rates because there are no alternatives to that, perhaps also looking at some of the regulatory bottlenecks, some of the regulatory hurdles that have prevented this access to financing from becoming that much more widespread. Increasingly, if there are seen to be profitable lending opportunities, one would think that financial institutions, especially looking to deploy cheaper means of mobilizing capital, going digital, going mass market, would look to exploit this. And is it an issue of the regulatory environment that is impeding this access to financing? Is it an issue that when financial institutions do find profitable ways to lend, a negative spotlight falls on those institutions and the regulatory backdrop doesn't necessarily help? There are many issues, and we could probably spend quite some time looking at this particular topic of access to financing. But suffice it to say that if the building blocks are in place, if we see a certain amount of macroeconomic stability, if we are in an interest rate environment, and there are a number of economies in the region now where inflation is expected to moderate from previously very high levels, then the expectation is that with more regulatory focus on this segment, with more questioning why are some still cut off from financing, perhaps more can be done to address this. But I think to answer the overall question, it's been a function of macroeconomic instability, high and volatile interest rates, the cost of mobilizing deposits, and the rewards not necessarily being in place because of the negative regulatory attention that might be attracted for institutions that are intent on lending to these supposedly, or the perception has been, riskier segments.
I couldn't agree with you more, Arazia. So on that, with that context, maybe let me turn to Ibrahim Adjouf here. So, given the urgent need to unlock domestic capital in West Africa, how is the BOAD supporting national efforts to formalize economies, expand regional value chains, and catalyze private sector investment?
Thank you very much, Vice President. I'll just, as my neighbor had done, just give a context also on BOAD. For those who don't know BOAD, we are the financial arm of the WAMU countries, the 8 countries, and basically we operate in those 8 countries, and that's where most of our investments go. And as I speak, we're the first investor in that region, and we do invest about 1.5 billion on a yearly basis in that region, and the recent exercise we've gone through in terms of increasing our capital base and moving from 1.5 to 3 billion will give us more capacity. I think we should have had this discussion also 30 years ago. I mean, we've been talking about it for some years now, and I think that it's time we just collectively add our efforts and solve these issues. And if you look at Africa, I think one of the capital we have is the human one. The first one is human capital. And we always talk about how young is our population, but I think that we need to talk about also how creative this population is. About 60 years ago, we all, after graduation, wanted to be a civil servant. 20 years back, we all wanted to be in the private sector. And if you look at our kids, they all want to create their own companies. And I think we need to follow that trend. So human capital, we need to really look at that young population as an opportunity, not as a threat. If we don't do it, then it's going to be a threat. And it's becoming to be a threat in some of our countries. Africa also is the only continent where when we find minerals, we're scared. We say, a war is coming. Whenever we find something, we say, okay, we need to watch out. There will be some problems. So I think we also need to make sure that we work on the governance piece of it. How do we manage it, and how do we really negotiate with the international players? The last one I want to emphasize on is diaspora. And I think that we need to have that diaspora coming back and investing in Africa. and they're not doing it, or we're not fully utilized. But they can't do it if we ourselves are investing outside. I don't want to take the risk of asking, the public and ourselves to say where our savings are. Are they in Africa or are they somewhere else? I might not be one of those also who will not raise their hand. But I think that cultural shift needs to happen. This is where we need to invest. Africa is where we need to invest. And we've seen things, we talked about the global situation now and people pulling out. Should we just sit out there and just wait for something to happen? Or should we take accountability and make sure that we collectively invest in Africa for the development of Africa? I think that's the key question. Thank you.
Thank you very much. I mean, you did raise very important points here, and I would like also the other panelists to react at one point in time. But let me now turn to Chika Modi. So Pan-African banks have expanded rapidly in recent years, yet banks lending in Africa remains slow compared to other regions. So in your view, how can Pan-African banks and commercial banks more generally shift their focus from short-term to long-term lending for transformational projects in Africa?
Thank you for your question. Let me follow the precedent of two of the other speakers by setting the context. So United Capital Group is a member of the Heirs Holdings Group, is a quoted investment bank on the Nigerian Stock Exchange, and we're licensed to operate directly or indirectly in 10 countries in the sub-region. Heirs Holdings is the same group that owns UBA Bank, and they have something like 40,000 people employed across the continent. In response to your question, I think the starting point is if you think of banks are rational actors, stating the obvious. And banks would pursue, they try to maximize returns and try to manage the risk in that process. This is important, and I'll explain why. The next thing is the idea of risk. So risk, which is born from uncertainty, increases over time. So we're pretty sure what would happen this afternoon. We're going to have lunch. We're not so sure what would happen next year or the year after that. And so the longer you go out in time, the higher the risk. And there's the expectation that with higher risk, you get higher returns. So unfortunately, this has not quite been the case with lending, when you bank lending within the continent. And the question then is, why do you have this disconnect? Because everyone agrees, there's consensus around the fact that long-term lending is beneficial for African countries. So the banks want it, regulators want it, governments want it, the public want it. But banks also have a responsibility fiduciary to their owners, to their depositors, because most of the money they have belongs to their shareholders. So first thing I would say is there's a bit of what I call a perverse incentive. So if you are in an economy like Nigeria, Ethiopia, Ghana, more of the non-francophone economies, as a large bank, your cost of funds are low single digit. So 1%, 2%, maybe even 3%. Now, the cost of risk-free instruments in those economies, government borrowing like treasury bills, are double digit. So in Ethiopia, 18%. In Kenya, it went down a bit at the beginning of this year, still high teens. In Nigeria, as high as 20%. So you make a very healthy spread lending the government by buying these instruments risk-free. So what is the incentive of lending long-term to the private sector that has higher risks if you're not going to get a commensurate return? So banks are being rational, and they're de-risking their portfolios by carrying liquid instruments that have a high return. Right. So now, are there bankable long-term projects? Of course, yes, there are. So why are the banks not doing as much as they could do, and what should they be doing? So the first thing is, if you think about it, if you have inflation at 30%, 25%, depending on what economy you're thinking of, 18%. Then in preserving value, the companies are going to seek to have returns higher than that. And if you lend money as well, you want to get higher than that. Now, if I lend money at 40%, even for a bankable project, it would look very unattractive. But that might be the kind of return I require, right, on the long term, because you're trying to preserve value against depreciation of the currency and against inflation. So unfortunately, if we're using interest rates and a few fees, you're not going to get those returns. So the question then becomes, what are the solutions? What can we do about this? The first is the courts of the government and the regulators. If you have a stable macroeconomic environment where inflation is low, where the exchange rate is stable, then lending long-term will not be as perilous as it is. The second is if we have mechanisms where we could participate in the profit of these companies beyond the interest rates, then there is an incentive to do that. The third is the paucity of de-risking instruments. So if I want to carry a risk and I have products that could help me mitigate some of that risk, then there's an incentive to do that for long-term lending. I think this, I'll stop at this point, and I'm happy to speak a lot more. Do I have more time on that?
Yes, please go ahead.
Okay, great. So I think there also is the issue of the appropriateness of the type of finance, right? And there are sectoral issues. And what do I mean by this? So some sectors lend themselves to preserving value against exchange rate depreciation. So it's not a coincidence that when you see lending in, I use Nigeria because my native country, and if you were in an industry like the oil and gas industry where they generate foreign exchange, or you're in some elements of tourism, then lending in that sector is not as, the risk is lower from an exchange rate perspective, right? Because even if you lend in foreign currency, they're able to repay that because they can absorb the exchange risk, because their pricing and returns are pretty much inelastic, right, to the exchange risk changes. Right, so one strategy is to do more of this, and it's not a coincidence that the largest projects you see in the region tend to be foreign currency funded, not just because of who's bringing the money, but even the domestic lenders lend in dollars. So if you think of the Dangote refinery in Nigeria or many of the other projects, they're still forex denominated lending because they're mitigating the exchange risk in those cases. And this is one strategy. The other obvious thing is that if governments begin to reduce the amount of their borrowing, if there's more fiscal restraint, and they're not crowding out the borrowing of the private sector, then that would lead to lower rate regimes and perhaps more stability in the long term.
Thank you very much for this perspective. And actually, I think that all our panelists have, brought a very interesting perspective to this discussion. And I really would like this to be a much more dynamic process. So maybe I will ask you to react to some of the comments you've heard here. Maybe I'll ask with Dennis anything that you want to comment on.
No, thank you, Madam Moderator. I just wanted to respond to my neighbor here. I think institutions are doing a lot in order to address the issues you raised. The issue of youth unemployment, the issue of the creative sector. If you look at AfDB, we actually established a department to cater for the creative sector so that we can create employment on the continent. It covers fashion, film, writing, and this will create jobs on the continent. And we've also realized that we need to work together as African multilateral financial institutions. So AfDB spearheaded the formation of the Alliance of African Multilateral Institutions. So we come together and share risk, and we can do more. So we are doing a little bit to enhance that. Even for ourselves, we are putting in place mitigating factors to enable our capital to go further. We are copying from the AdB, they introduced the room to run, and we're also doing the same. We are enabling our financial institutions to lend by providing guarantees, risk participation. So we are trying to do our little bit.
Is Abena Amwa, do you want to?
Thank you very much. I think a number of interesting things has been said, but for me the key thing, and someone said this yesterday, debt capital or bank financing is to run a business, but to grow a business, equity capital has to be looked at. And we all know, at least from our schools, that there's an optimal mix of capital, which is equity and debt. In Ghana, the Ghana Stock Exchange runs both a fixed income market and an equity market. And what we've realized is that working with the local pension funds, we've been able to support corporates to access finance cheaper than their alternative financing options. I can give an example. We launched a commercial paper market last year. A commodities trader came to that market, raised 150-day paper at 17% versus the 27% they were paying their banks, with financing from the pension sector. Another institution came, issued 3-year paper at, again, almost a 700 bips difference between what they were getting from their banks versus what they were getting from the pension sector. So for me, it's developing the products and using our long-term savings and tools to finance the corporate sector. And we keep saying the private sector is our engine of growth. And yet, when you look around, there are so many state-owned enterprises that we say only governments can provide that service. We used to say that for telecoms a few years ago. I remember my family put in a 5-year application and we still couldn't get a landline. And we showed today that private investments has revolutionized our telecoms as well as our financial inclusion target. So my first call is that I think our governments are crowding out private investment, and we need to partner both. There is plenty room for our pensions and for our retail investors to invest in our economic sectors. And I love what my colleague said about it. Where are we investing our money? If we are not creating opportunities for all of us to invest in our housing sector, our creatives, our financial services, all that money will leave Africa and we'll keep talking about the same things. So put out SOEs, all commercially minded SOEs on the markets, the public markets. They are good for 2 things: access to capital, as well as better governance practices. Those better governance practices ensure sustainability and development here. 2, enable tech platforms. No one wants to walk into a stockbroker's office and open an account and all of that. Create AfDB, support the market, create Africa Invest platform. Let's put all the insurance, stocks, everything on one app that every African person can download, put in their national ID, and start trading across the market. The securities exchanges are doing something under an African Exchanges Linkage Project, which will put over 2,000 companies on our securities exchanges on one platform and enable cross-border trading. Will the government allow us, through PAPs and other tools, allow easy settlement? We are hoping so that we can do cross-border listing. And I think that as we create more opportunities, retail investors, institutional investors will have more options, and companies can raise the capital that they need to fund the growth and wealth creation we're looking for. Thank you.
Thank you very much, Ms. Amwa. Dr. Razia Khan, would you want to come in?
I'm sorry, I didn't hear very much of the question.
Okay, so I just wanted you to react to some of the things that you've heard today from our panelists. Anything that you want to add?
So I think what really stands out is the opportunity in other African markets When we're talking about mobilizing financing in Africa or making financing work for Africa itself, one of the topics that usually goes unaddressed is just this issue of where the capital flows are going to come from. We know that the region as a whole has been disadvantaged by global shocks, and the impact of that global shock is always deepened as a consequence of what happens to the availability of financing, the availability of capital when the region is subject to those shocks. So we think back to the COVID crisis, an exit of a lot of investors, a flight to so-called safe havens, many African economies finding it very difficult to refinance their dollar obligations in international markets, and an inevitable wave of defaults that followed, simply reflecting those tighter financing conditions. We know that we're in a very volatile world today, and again, this is the risk. Not only do we see rising trade tensions, we'll have to see how these eventually settle, but the impact of all of this uncertainty has not been favorable for the region's commodity exports, but equally there's a focus on the financial channel through which African economies might be impacted. Once again, it becomes very difficult to issue in international capital markets. Access to much needed financing is that much more complicated. And I think the message here is that we really do need to be thinking of longer term solutions. Now, for many offshore portfolio investors, the opportunities in select African markets are still very significant. If you think of where a lot of those portfolio flows have headed in the recent past, Egypt because of the attractiveness of the yields and still the great attractiveness of the real yields, countries like Kenya that saw a significant currency appreciation. We've seen the Ghana cedi appreciating on the back of rising gold exports, and investors, not least investors from the rest of Africa, very, very tangentially involved in that. So I think if we're going to change the mindset that every time there is a global shock, it's inevitable that African countries, African markets will be impacted negatively, we do need to focus a lot more policymaker attention on how easy we are making it for African countries to seek their financing from other African countries. There's been, for good reason, a move towards greater regional integration when it comes to trade, the breaking down of those trade barriers. If anything, the presence of a whole new global shock so soon after the last shocks, after the COVID crisis, followed very quickly by the developed market inflation crisis, the rapidity of higher interest rate tightening, and the impact of that in Africa, we need to start thinking much more about the broad-based solutions available in this region itself. So just as we're talking regional integration, just as we're facilitating the availability of payments mechanisms that might ease the ability to pay for the exports of other African countries, African financial institutions, pension funds that are able to mobilize a great deal more savings should also be involved at looking at the opportunities that exist for investment in the region. Now, why doesn't it happen? When we talk about trade, we talk about the lack of complementarities, the fact that similar countries may be exporting the same thing. They don't really need to trade that much with each other. When we look at the likelihood that countries will be hit by financial shocks, perhaps what is impeding this intra-regional financial investment, the flow of capital between different African countries, is the perception that they will all be hit by the same external shock and all be negatively impacted in the same way. But if we start to measure the amount of financing that is mobilized from the region itself, if policymakers shift their attention to perhaps giving greater regulatory encouragement to that flow of capital into the rest of the region, maybe this can start to be the beginning of a whole new trend that over time creates greater resilience to these global shocks. No one is suggesting, given the nature of the shocks, that this is going to be immediate, that this will be easily done, but we could start by measuring it as a means to bringing about different outcomes.
Thank you very much, Razia. Thank you so much. So, Mr. Diouf, do you want to provide your perspective?
Yes, I just want to say a couple of words on access to financing, and it was mentioned. And obviously it's an issue, and I think that we collectively have failed in dealing with that issue. And for sure what we've been doing so far will not take us where we want to be. And I think that's where the development banks have a key role to play. You know, I've been a development banker for the past 5 years. I spent most of my life on the private sector, on doing commercial and investment banking. And one of the things when I was running a P&L, one of the first discussion I would have every morning was with my treasurer, how much have we made yesterday? And if you have that kind of mindset, you probably not going to be looking at where you can make money versus where you can impact. Now, what my president tells me every morning is, if you cannot impact people, you're useless. If we cannot collectively impact the people, we're useless. And I think that under the leadership of AfDB, I think that's where we need to. I know we do a lot of things. We partner. All of the development banks partner. We get into other financial institutions, capital equity. We invest in equity, and we have lines of. But I think we need to do more, and we need to get to a level where we have a club, and look at this issue and say, let's solve it collectively. How can AfDB, BOAD, Afrexim, TDB, and the rest, these key, and Badea, these key financial institutions can team up at their balance sheet and solve this issue? And I think that if I were to say something to AfDB, because we're hosted today by AfDB, I think it's your challenge today to make that happen.
And at the AfDB, for each challenge, we have a solution. We'll get there. The last word, Mr. Morty, please.
Well, let me leave on a sort of optimistic note, and that's talking about the African diaspora. So you talked about human capital, and I think there's no doubt about it that Africa has incredible human capital. And the one way you could see that is to look at the diaspora and see, if you pick, for example, if you pick the United States and you look at Nigerians in the United States, they're by far more educated than the average person in America, by a factor of 27%, of more than 3 out of every 10 being graduates. They're wealthier in terms of the average income. They are more law-abiding. That would be a bit interesting because they have lower rates of being jailed or breaking laws and being convicted for that. And it's an important segment because you're seeing massive flows. Everyone knows about this. I'm not going to rehash that. But something in the magnitude of $28 billion is expected to flow to Nigeria this year from the diaspora. That is very significant. That dwarfs all receipts in bad years when it comes to oil. Now, we need to tap into that as we think about even the capital markets. And there is an initiative the central bank, which we're helping them work upon, has, but this should be something across the continent. And they'll be more disposed to longer-term investments within the country just because they're from the continent. Thank you.
Thank you so much. And ladies and gentlemen, a big round of applause for this excellent panel. Thank you very much. So